Hi, folks. Here we are. Extra show this week. It's Thursday, not Tuesday, for those checking their diaries. But I thought it was worth coming on. Perhaps have a few reflections on what's happened in the US over the last 48 hours or so, and also want to answer some specific questions about mortgage underwriting. I had quite a few questions in recent days, and I felt it was important to try and cover some of those off. So we will hopefully get started. Chris hasn't joined me yet, so we might see whether he does. He should. He said he was, so we'll see. Anyway, we can still have an interesting conversation, even if Chris is late. So I hope everybody is well. Obviously, the news of the last 48 hours is, concerning in a way, but the level of uncertainty has gone up. We might talk about some of those things too. Just in terms of where we are, the dogs are there. I am here. You can see the setup pretty much as normal. I'm on my own screen at the moment because Chris hasn't joined me. And in terms of the dogs, they are there. They've had their morning exercise. They've had their breakfast. And out for the count, hopefully for a little while. Until somebody comes to the door, as I think I've said before. So that's pretty much it. Good to see some the old faithfuls on tonight for the extra show. Thank you very much for taking some extra time out of your week to spend it with me. Really appreciate it. And I would remind you to like and share this post and this show. It does really help with the algorithm, and certainly the likes and shares do make a huge difference. Really does make a huge, huge difference. Anyway, what I'm going to do now is I'm going to take the pre-show off. I'm going to run the start of show and we will get going formally. So I'll be back in just a moment. Well, good evening and welcome to this live stream on Thursday, the 7th of November, 2024. It's Martin North here from Digital Finance Analytics. Great to have you on the stream tonight, and thank you very much for taking some of your time out on Thursday as well. The purpose of this show was initially to talk about some of the mortgage underwriting questions that I've been receiving in recent days. There's a lot going on in and around mortgage underwriting, and part of that is to try and get some reads on some of the issues that are going on. Have to tell you that Chris Bates hasn't yet joined me. No message to say he's not, so let's assume that he's just a bit late. But I thought what I would do briefly is just talk a little bit about the news from the US. I made a show yesterday when I highlighted the fact that the critical issues that really drove the swing towards Trump were pretty simple. They were that many people across the US aren't feeling it in terms of the economic prosperity. They feel worse off. Trump, of course, pushed that quite hard. And I think that is really an important message. So, there are lots of other issues, of course, the climate change story, the Roe versus Wade story, all of those things are there in the background. But at the end of the day, people will tend to vote based on their hip pocket, and I think directly or indirectly relating also to the migration question. So those are effectively the sort of the forces that I think drove a lot of the responses. Now, there were some demographic shifts. The Democrats didn't get the shift towards female voters that were expected, interestingly. But I think that you can also look at sort of some of the black vote and some of the other sectors there. But I do think the economic drivers, that people are not feeling more wealthy compared with where they were previously, and obviously more concerned about cost of living, because whilst inflation may be coming down, the truth is that the real rate of costs of spending are still much higher than they were if you go back 2 or 3 years. Now, the same is true in Australia, of course. And so my point there was that given the discussion now in Australia about the election, there's going to be some interesting questions as to what extent Albo is going to steer the conversation. He's always talked about cost of living, but has done it through in a way that's supporting inflation. The RBA, of course, looks through the electricity costs and those things, and the support from both state and federal that were given. So I think this is a really important question. And, as I reflect on all of these issues, I think that there's a level of uncertainty. I was also interested to see that the commentators were really almost completely of one mind, saying the level of uncertainty as a result of this result in the US has risen. And I guess that's the economic situation, the international situation, and some of the conflicts around the world. Ukraine, of course, comes to mind as well as Israel. So all of those things are there in the mix. And bring it back to Australia specifically. If we actually see similar strategies in Australia to what has been done in the UK recently, I think that tells us something really important. Now, in the UK, we had a budget last week. And that budget was quite interesting because despite what they said before the election, that they weren't going to put taxes up, they weren't going to put national insurance up, which is another form of tax, or indeed VAT or GST equivalent, what actually happened was that they put the costs to employers up for employing. So they put what's called the employer national insurance up. And what that did was effectively lifted the amount of revenue coming into the government significantly, but they also imposed a lot of additional costs on, for example, those moving through the generation. So we have in the UK a tax on the estate over a certain level when people die, and they've also now pulled a lot of other things into that estate tax, the death tax, whatever you want to call it, including superannuation and even farms. So what it actually means is that what we've seen in the UK is a very strong pivot where effectively the revenue from assets and from those more affluent are actually now very much in the spotlight when it comes to tax creation. In fact, they changed the rules as well in the UK to be able to borrow more. As a result of that, the bond rates actually went up quite a lot before the US election. Bond rates, of course, have gone even higher after that now. So it is an interesting pivot. And I would argue that what we're seeing in the UK is a focus on younger people. For example, they lifted the minimum wage, but actually a very strong focus on getting more tax income from the more affluent. So there's a pivot away from the affluent towards the younger. Now, I would argue that in the US situation, we're seeing precisely the opposite. What we're seeing there with Trump is effectively whatever he says, the people who are going to benefit are actually at the top end of the income and wealth scale. So it is interesting to see these two different scenarios playing out in the US and the UK. It'll be really interesting to see what Albo does, because effectively what Albo has done is not tackle some of the big issues as we've discussed previously, things like gas, the gas reservation, which has put huge imposts on gas prices, and also raised a bunch of other questions as well when it comes to the question of how households are travelling. And whilst inflation is coming down somewhat, I think it's still going to be there. Now, it's interesting. Chris Bates has just joined, so let me just bring him in. Just bear with me a second. Mr. Bates. Hello, Chris. How are you? It's all right. No worries. You're actually on live at the moment, so I'm just going to bring him into the stream so people can see you.
Can you just give me 1 second?
Yes, of course. No worries. So the good news is that Chris is here. So he has.
Just give me. I want to change my t-shirt. Just give me a sec.
Okay. So Chris will be back in just a moment. That's good news. Oh dear, oh dear, oh dear. The things we do. So yeah, as I was saying, the view that I have of the world at the moment is that there's this really interesting pivot going on, And if you think about the other aspect in Australia, which is very current, of course, is the misinformation and disinformation bill. And what that basically means is that the story that the government wants to tell will predominantly be the story that is told. And what that basically means is that some of the debates we should be having won't necessarily be having. So all of those things are in play at the moment. And what this basically means is that many people will not necessarily have the full story when it comes to the next election if the MAD bill comes in. So it is really, really an interesting time. And I think internationally we've got uncertainty. We have this divergence of opinion in different parts of the world in terms of how to deal with the economics. And, the bottom line, therefore, is it's quite complicated. And I think Australia is a bit caught in the crossfire. I think that probably some of the issues with regards to what China is doing, and especially if high tariffs are imposed on China, will necessarily flow. We might get cheap goods from China, but that isn't necessarily the full story. Anyway, Chris, are you installed now? Yeah, great. No, well, thank you very much for coming on. And we were just having a bit of a preamble about the US election and everything that's gone on. So it wasn't like there was nothing to talk about.
Am I live now, Martin? It's,
you are live.
I think we've been doing these for 5 or 6 years, so hopefully people can see the funny side in this. I was literally actually going to bed. I've just got the kids to sleep, I thought, and then I was just about to drift off and went, oh my God, Martin. So it is actually quite funny, to be honest. So apologies for everyone. My brain must have remembered just as I was about to fall asleep. So anyway, I'm here now, Martin. Let's do this.
Thank you. No, thank you, Chris. And look, the reason that I wanted you to come on was because I've had a bunch of really quite penetrating questions from a number of followers relating to the mortgage underwriting game and what's going on at the moment. And I wanted to get, you are a award-winning mortgage broker, you're managing the Flint Group, all those things. So I felt you were the right person to help us with some of these questions. So it's great that you could come on and spend a bit of time. Just before I throw the questions at you, though, just give me your top-level view. There's a lot going on in the property markets, right? So we've seen a little bit of easing back at the top end, particularly in Sydney, but at the bottom end, it seems a little bit buoyant. Banks seem to be changing some of their underwriting standards irrespective, and they're also lobbying for the 3% buffer removal for first-time buyers. Some are, some aren't. What's your take on what's really going on?
So, it's always it's a moving target, right? So we're getting to start of November. I'm surprised there's still been some decent listings in the last week. I thought that would... So it's really the last week. You wouldn't want to list your property anything later than now, right? Because it's getting too close to Christmas. But, there is a little bit of stock on the market, right? And a little bit of come on, but basically it's going to die now. And particularly, I think even overnight when you see the US election, that's only going to create further uncertainty around what's going to happen to interest rates, what's going to happen to inflation. And, that uncertainty around interest rates usually, which you can see over the last few years, stops people transacting, right? It stops people selling properties. Hence why listing numbers, total listings and even new listings are really down on long-term standards, right? And so I think that we've seen our buyers be a little bit more cautious probably over the last 3 or 4 weeks than they were in September, October, particularly when the rate expectations really dropped. And we thought that there could be 1% of rate cuts in 2025. And, a lot of the data was coming out with some pretty good news. I think only a flurry of activity in that period. Am I still here, Martin? I think my video's just gone off. Didn't know she did that.
Yeah, it dropped off. It's come back.
Yeah, it's come back. So so when there was that rate expectation really flipped, and I think we chatted not too far away from there. We absolutely saw buyer urgency increase, right? And particularly in the $1 to $2 million plus range. We hadn't seen that for a good 12 to 18 months. There was a real appetite to transact and try to get ahead of these rate cuts. I reckon that's sort of died off again. I think buyers are a little bit more patient, a bit picky again. And there's a bit of buyer fatigue. Naturally, at this time of year, buyers are getting a bit over it, and they're just saying, hang on a sec, let's just get through to the end of the year and we'll start our journey back up next year. So yeah, that would be my overall take in sort of the Sydney market. You're right though, the affordability part of the market, investors and is getting driven just because of the rental crisis. And there's still a lot of investors in the market, which I think are a lot of actually first home buyers that are actually buying investment properties. And so they're going down as investor lending, but really they're first time buyers that can't afford houses or homes. And they're just buying an investment property. And so, yeah, that's my overall take on the market. I think obviously there is the expectation that, rates are going to look more favorably over the next year or so. And I think as that gets more and more certainty, I think buyers will get more and more urgent. But there's always the lag in listings, right? People can enter the market as buyers within 24 hours, all of a sudden they can flick that switch like I just did then and realize they probably need to be on Martin North and they can enter. But sellers take some time, right? They've got to get the agents. They've got to usually do some repairs. They've got to style it. They've got to get rid of tenants. Like it's a lag and it's a big decision to sell. And so generally what we see is that when confidence picks up, listings lag. And you think about like a time like 2019, I can see that sort of similar scenario happening where people are just holding off. And then when urgency comes back, it can come back with a bit of force, which it kind of did in September, but it really didn't have much steam behind it.
Yeah, very interesting. And just one quick question on the 3% buffer removal. It's interesting how not all the banks are actually supporting it. Westpac actually in their evidence said, we don't want a change. We actually think that first-time buyers are actually more risky. NAB said we don't see any difference in the risk between first-time buyers and the rest. ANZ has been pushing quite hard for the removal of the 3% buffer. And of course, it's become a bit of a political hot potato now with Senator Bragg pushing it really hard to try and actually be seen to be helping first-time buyers. What's your take on it?
Oh, look, I do think it was interesting that they all just weren't for it, right? End of the day, reducing the buffer increases how much money they can lend. It's going to increase their credit growth. It's interesting that the two banks with the biggest market share didn't want to increase it. Reduce it, increase borrowing capacities, and the ones with the smaller market share did. So I thought that was interesting, right? Like maybe because they're worried that, another rate war and would kick off and then their lending, their market share might not be sustained. So maybe there's part there. I mean, ultimately, I think the issue you have here is that what they're saying is that first-home buyers can't enter the market because their borrowing capacity have dropped so much. Prices haven't dropped by as much. And it's really becoming a market driven by medium and higher income borrowers. And CBA, who don't agree with reducing the buffer, have released lots of research on this and other banks as well, and showing that it's really a have and have nots. Who's earning income and who's got access to equity through intergenerational wealth. They're the ones who are able to transact, and everyone else can't because prices and their borrowing capacity just don't align unless they make huge compromises or come up with a different strategy like buying an investment property. And so, the irony of this, though, is if you do give more borrowing capacity to first-home buyers generally buy where other first-home buyers are buying. And so all of a sudden, as soon as that money flows through to a first-home buyer's borrowing capacity, what are they going to do? Rock up at the auction the next weekend with a bit more cash? Well, they're just competing against other first-home buyers who have now got more cash too. And then very quickly, that'll just get factored into prices. So are you really getting an advantage? Well, probably not, because the first weekend that you go out to auctions, you're probably going to have to spend more money anyway. Because generally a lot of first-home buyers just naturally buy in similar spots due to price points that they enter the market. And so I don't know. I think it's you can see why they want it. Higher loans, more borrowing capacity, more credit growth. Do first-home buyers really want it? I don't know. I think you think you're getting a benefit, but I think you're just going to pay more money and end up with a bigger mortgage. It's similar when Dominic Perrottet sort of didn't have stamp duty up to 1.5 million. First-home buyers were like, loving it. Yeah, I can enter the market. But you very quickly saw properties from 1.2, 1.3 go for 1.5 million. And so would you prefer to pay 65 grand of stamp duty, or would you prefer to pay an extra 200 grand in a purchase price? And absolutely, that's my worry here is if you give people more borrowing capacities when they're stretching to every dollar, because they're saying, what's the max we can borrow? 950. Okay, we need more than that. So they're spending everything they can possibly borrow, and they're rattling the tin to every single family member and selling everything they can to do it. If you give them an extra 5-10% borrowing capacity, they're just going to go and spend it. And so that would be my worry about reducing the buffer.
Yeah, and this is interesting, Chris, that the story, of course, is also here that the effect on providing ever more credit is to continue to push property prices even higher. And we saw that last time around, and I see it again now in some areas where there's a lot of people chasing property and prices are still higher in some areas. And I guess one of the other observations is that the story is much more complicated than saying property prices are on average going up or down. You have to look granular, as we keep saying every time on this show. Granularity is pretty critical. Just before I throw the first question at you, I had one from the chat here. This is actually from Jason, and he's asking about Melbourne. Now, I'm not sure whether you're sort of across Melbourne, but I can certainly help here. So Jason's asking about new investors in Melbourne. Are there any? And a lot of auctions are being passed in. One of the things that I'm seeing in my data in Melbourne is a lot of property investors selling because of the fact that the rules have changed. They've got to do more in terms of the property maintenance and those things. But we're also seeing some property investors buying in Melbourne. And I'm scratching my head a little bit about how can both be true at the same time. But I think the truth is that not all property investors see property in the same way, nor indeed necessarily. Oh, sorry, that's my doorbell. The dogs are going to go off in a second. See, they do. Shh, be quiet. Yeah, sorry.
Right, it's not as bad as me, Martin. I was almost asleep 12 minutes ago. So how can property investors be selling and buying at the same time? You're right. There's a bit of a juxtaposition there, right? Absolutely. I think a lot of property investors in Melbourne have been disappointed with their returns. Firstly, a lot of them have bought apartments. And Melbourne has basically had a building boom for 15, 20 years. Apartment prices have pretty much done nothing, particularly in areas where there's high density, and you think the Richmonds or the city or it keeps going on. Like Melbourne just built apartments for fun. It's a flat city, then it's easy to build on. So the apartment prices have basically done nothing. So a lot of investors fell for the apartments, and they've done really poorly. And so a lot of investors would be bailing because their returns have just been very average. They're negative. There'd be negative cash flow with higher interest rates. Then you've got people who haven't got into apartments, and maybe they've got into housing, and changes like the land tax threshold dropping, meaning that you pay land tax pretty much on any land that you own in Victoria right now. Things like the Airbnb tax, you're right, around the tenancy and maintenance of properties, etc. So absolutely, some investors will be saying enough's enough. And maybe they're just having to get out because their home interest rates are really struggling, and they're going, well, I just need a buffer. I just can't afford the negative cash flow. And I'm just disappointed in my returns. And I think a lot of investors would just be bailing because of all those things. However, on the other side of the coin, if you look at, because underperformance hasn't been great in Melbourne, and particularly even in the housing market, when you compare it to Adelaide, we're up 60, 70% since Perth, similar, Brisbane, similar over the last 4 years. Sydney, maybe not so much. Melbourne, from an affordability point of view, and when you look at, particularly in the housing market, comparing it to other cities, you'd have to say it's a pretty good bet. And before, because Melbourne prices haven't done much, and all these other cities have done quite a fair whack. I think that affordability benefit for, say, someone in Melbourne moving to Brisbane just isn't there. It really was there, say, in 2017, right, when you could sell in Melbourne, and then what you could buy in Brisbane for dollar, you'd be like, wow, it's such a better life up here. Let's move up here and get a much nicer house. I just don't think that's there anymore. And I think Melbourne will get its mojo back. I mean, I was born there. My dad lives there. I've spent many years living down there as well. It wasn't that long ago where people were saying it's the best place in the world to live, right? So I think Melbourne will get its mojo back. I think the return to work is a big part of that. Melbourne is all about the city and the cafes and the culture and the restaurant and the sporting events, etc. And so I think bit by bit, employers are, forcing staff to come back to work. That sort of work from home, true, like remote work, I think it's sort of dying. And so bit by bit, I'd say the Melbourne CBD is going to get its mojo back in the cities. And so ultimately, it's got huge population growth just because of the migrant communities that have been building for generations, and employment. You can't argue with its economy, how diverse it is. I mean, the government's in a bit of a pickle, but I don't know. I think that's why Melbourne's a good bet. I think it's just got a lot of intergenerational wealth, a lot of wealth within the city. It's a lot of higher incomes down there, and I do think a lot of people want to, run businesses there and live there. And so ultimately, there's also a restriction of housing. Yes, you can keep building these greenfield estates, and down in the Cranbrook area or to the north past. Way past Coburg, right up past Reservoir, all up to the north, or you can go, in the inner west, Meltons, and all those sort of areas out to the west. So you can build greenfield estates, you can build apartments, you can build lots of new townhouses. But in the housing market in particular, there is true scarcity, particularly when you go on quieter streets and not train lines or tram lines, and and so I think Melbourne's a good bet, but I would definitely be going into the housing market if you could, and like a heritage style home.
Yeah, certainly units are not doing very well. And certainly in my analysis, a lot of the outer suburban houses are not doing well. The mortgage stress has gone through the roof. People are highly
Absolutely.
leveraged to the gills. The rental returns are capped now, partly because of what people can afford to pay for rents, and also the fact that these costs, additional costs, are on investors, and that means that from a net investment perspective, they're actually more and more underwater. So we'll see. There are people in the chat who think that Melbourne's cooked, so they're interested to see your perspective. Now let's just throw these questions up relatively quickly, Chris, because I know you want to get back to bed. But so I had eight questions that really tried to crystallize the conversations I've had multiple times with people over the last few months, right? And so the first question is this. This is actually from somebody called Chris as well. Planning to apply for a first-time buyer mortgage early next year with cash from parents. So the question he asked is, how long should the funds be in my account? And will the bank ask about the source of funds when they actually come to the underwriting? And does it make a difference?
Look, there is some times where genuine savings does matter, particularly loans over 90%. Banks, it's a higher risk loan, and they just want to see that you're not going to get sticky fingers, and you basically just don't spend everything you earn, and you've got some good savings habits basically. And so generally then they'd want to see a good 3 months of just the money sitting there. And but once you start getting under 90 and you get 80, etc., all those sort of things start to become less concerned for the bank. So I mean, Chris, unless I'm Chris, but I'm assuming he's Chris. But I would say probably, if you're going to be looking at a loan, above 90%, be looking at the 5% deposit home loan scheme as well, which is the government scheme. I'm not sure if you're eligible for that, Chris, but check that out. There is caps on that in terms of incomes, and also in terms of city caps in terms of where you're looking to buy, etc. But you might be eligible for that. But yeah, I wouldn't stress about it too much. But if you are going over 90%, it probably makes sense to try to get in there for 2-3 months, and just show some really good habits. Make sure you've got no issues with your credit file, making sure you're saving. Banks are risk on at the moment. Absolutely, if they can lend money, they will, and they'll make exceptions if they have to. They're not in a time where they're really concerned around credit, like a Royal Commission, or when lending was really getting pushed and getting watched from APRA.
Yeah, my observation, Chris, is that the banker mum and dad, which is very active, more than half of first-time buyers are getting some sort of help in my data at the moment. But the banks don't seem particularly perturbed by it, and don't, unless, as you say, they're really knocking up the 90%, then it's not a big issue. But generally, you need to be able to explain where the money has come from if they ask. But the question is, will they ask? And the answer at the moment, quite a few don't seem to.
Well, that's right, exactly. And so it's like, there's compliance that brokers have to have, right? So we'll have this, and we'll do a discussion, etc. And then it's what the bank cares about, really. And so we'll lodge an application, and It's up to the bank figuring out how many questions they want to ask. And a lot of banks, when they are risk on, won't ask those questions, right? They've done their checks. And sometimes they'll be really concerned around certain things, whether it's bonuses or lines of, in COVID, it was what industry were you in? Or, if you're a business, they wouldn't. So there's times when then credit is absolutely really tough. I mean, nothing tougher, to be honest, than 2018. That was a crazy year to be a broker. Great clients were getting declined. It was just, confusing, to be honest. But at the moment, it's risk off. And things like living expenses, if you wind back to the Westpac versus ASIC case, the Wagyu, not Shagyu, case, that was a huge moment. And that was when lending was really, really, really tight, and really scary, to be honest. Banks were looking at through everything, all your line by line through your bank statement. And yeah.
Yeah, thank you for that, Chris. Well, let's go on to the next question, because this is quite an interesting one, which I'm sure you'll have an opinion about. So this is from Locke, who says, are all mortgage brokers the same because they access the same lenders, or are there some differences? And if so, how do you pick a good one?
Look, we're pretty much exactly the same, right? If you think about it from a bank's point of view, a bank's going to want to work with every broker, right? So about 19,000 brokers. And brokers get licensed through aggregators. So we've got, Connective, AFG, Loan Market. That's probably 60% of the market there. And you've got Lendy, which is, Aussie basically. And then you've got some smaller ones like Finsure, etc. Right? So, and SFG. So, all these aggregators basically have a panel of lenders that they sign up aggregator agreements with all the banks. And so pretty much when you go to every broker, they're all going to be licensed through one of these big aggregators, and usually they're going to have access to pretty much identical lenders. Now, there are times when, for example, HSBC only worked with a couple of aggregators because they were out of the broker market and they've come back in. Athena, for example, they're now with Mortgage Choice, which is like the REA group. And not every broker's got access to that. So there are lenders, but when you look at the loan flows that go to these lenders, it's probably sub 5%, it's probably 3% or 2% of total loan volume go to these lenders. And so most brokers, or pretty much all brokers, probably have access to where 99% of fund flows go, right? And so every broker, and they all pay the same thing. Brokers don't decide what commission we get paid, etc. That's through the banks. And it's not like if one broker gets paid more using this lender versus a different aggregator. All those volume-based bonuses and issues like that got stamped out well before the Royal Commission, but even further through the review of mortgage broker remuneration, which was all good things. And so, you're trying to compare brokers and what they can access from a lender's point of view. It's a bit of a mug's game. They can all do the same thing, right? Some brokers get better service from lenders, depending on the size of the volume of loans that they do through banks. We've got, faster access for all the banks just because of the loan volumes we do as a business. But and that is a consumer benefit. But even then, I wouldn't pick a broker based on just because they can get you a faster turnaround time. And usually it does come down to experience, right? So you do want someone who's not only been doing the job for some time, because you do get better at it over time, like every job. But also they've got to be quite active, and they've got to be a little bit creative in terms of understanding the real challenges that you have. And so if you're an investor, you really want to have a broker that's quite skilled in bigger investment portfolios. Like if you're transacting at the higher end, you definitely want to work with a broker that's quite experienced in working in that market. Like some brokers just do a lot of refis, but they don't really know how to add value to first home buyers. And so just ask them questions, and, with the broker, just make sure that they, do have some knowledge, not based on bank products, but really based on strategies and options and scenarios and different options you've got based on your situation. That would be the first thing. The second thing I'd do is a bit of a test. Would be, how quick do they go start talking about products, right? Like really great brokers don't talk about products, because what they're trying to do is figure out what's your plans, like what's your moves, what options are you considering? Because, and asking you lots of questions around that rather than just trying to sell you on some amazing rate. And so a good broker, I would say, is asking you a lot of questions. starting to think through your life, challenging your thinking as well, not just going for the easy option. So you rock in saying, I want to buy this apartment and it's my first place. And they go, okay, cool. Yeah, we can do that. Now that's not what you want. Like brokers should be upping their game. They should become more of a trusted advisor in your life. Okay, why are you doing that? You're going to live there long term. What are you going to do after that? You're going to sell it, and great brokers sort of start to challenge you and help you think through your decision. You might end up landing where you thought you were going to land all the time, but they act more as a trusted advisor, and they're trying to find clients for life. I mean, that's ultimately what our business is based on. We've been going for 10 years now. It's what we're trying to do is add a lot of value up front, and really help clients make great decisions, not just in terms of how they structure their loans and the product they use. That's simple, but really what are they doing from a property decision? And great brokers, I think, take time to help you make that decision, right? And then they also I think have enough knowledge to know the difference between a good property decision and a bad one, and who not to let you speak to, like who you should avoid talking to, and who you should potentially speak to in terms of a buyer's agent. And what's the property fundamentals? If you've been a broker for a while, you've seen a lot of people come through your doors or your virtual doors, and when your clients come to us, we can say, okay, you bought that property, and you can quickly jump on CoreLogic. Oh, you bought that in 2006, and you paid 400, and it's now worth 450. You start to ask questions, and I think over time, that knowledge, great brokers use their clients as learnings, and as over years working with clients, I go, that really worked really well for that client. I wonder why that was. And I think that's what you get access to when you work with the top brokers.
I think that's the key point, right? So whilst they might have access to the same loan sources at the end of the game, there's a conversation in the middle, which is the difference between a good broker and a bad broker, right? Because a good broker won't just say, sure, how big, right? They will actually take you through a more detailed conversation, and sometimes may even challenge your thinking, and that sometimes is a good thing, right?
Oh, absolutely. I think coming from an advice background, I got skilled in this over many years, and you absolutely don't go, oh, what you're doing is wrong. What the hell are you thinking? I can't believe you were going to do that. That's not obviously what you're doing. The market is very confusing. You've got a lot of interested parties, everything from the media, you know what I mean, like the property brokers online. Like there's so many thoughts, the newspapers, etc. Right? And so, and people don't buy property every day, right? And even parents and friends, they don't know what they're doing. They've only bought a few properties over their lifetime, and so people absolutely are trying to do the right thing for themselves. And, sometimes it's just opening their eyes up to, oh, these are some of the challenges with that strategy. And this is, some of the issues you'll find with that type of property, which they haven't thought about. And these are some of the things I can see could be an issue for you in a few years' time if you just bought that property and you hadn't thought through what you were going to do maybe when you got to the kids stage. Or, I know it's easy to buy, but these are some of the reasons why. And it's just sort of opening them up to an alternative view on, rather than, you're right, absolutely, some brokers don't like to do that. They don't want to ask any questions that slow down the transaction and make it any risk of them not getting a deal done. And I don't think those brokers end up, achieving that much, to be honest, because I think clients realize that. They go, hang on a sec, the broker didn't really add any value to you. All they did is just do the loan, or I'm just going to leave and go somewhere else. And I think those brokers never get out of the first gear in terms of their growth, because their clients never really stay with them long term. And so, yeah, and I think clients really respect that, obviously. Sometimes they're hard to hear, particularly I've had clients with, huge portfolios and things that, they don't want to hear, but, or I've stopped them, following down certain type of properties, and or they decided not to go ahead with us and they ended up doing it anyway, and they've come back years down the line and they've gone, I realize what you were saying now. And particularly when clients have stopped doing something, they've done something else, and then they go, hang on a sec, it was that conversation that really stopped us doing that. And they're clients for life, right? And then they refer, and so it's in a self-interest sort of way here anyway. Like you think, oh, hang on a sec, you're telling clients things they don't want to hear. That's not going to be good for you. Absolutely, it is. It's because ultimately these clients stay with us and they don't want to go anywhere else.
Yeah, great. Thank you for that. And it's interesting because Boss Man actually threw in the question, what's the advantage of a broker versus direct? And I think the answer is you might get similar rates one way or the other, but actually it's that broader conversation that you don't have with a bank, right? Because by definition, a bank is just thinking about the mortgage rather than the overall situation. So I think that's how I would summarize that.
Yeah, I mean, there's sometimes that, like CBA, for example, they have potentially there's a bit of channel conflict going on with it. If you go into a CBA branch versus you're lodging a loan and the speed and rates and, like ultimately, if you go directly to the bank, just in terms of the way they set their loans up, that potentially you can get a faster outcome. And the issue you got is though, who are you speaking to in the bank? How long have they been working for? If they're any good at their job, they get moved. And the reality is they're always on the hunt for the next person that they can climb the ladder. I actually started out in some banks in the UK, and I was working at one of the poorer branches in the area. Then bang, I'm at the top branch, and then bang, I'm sort of got three branches. In terms of like all of a sudden, and people naturally within the banks get moved. And so, yeah, you might have a relationship with someone now, but good luck in 3 years' time when you want to do a renovation or upgrade that they're there. And the reality is, if they haven't got their reputation on here, or they don't really care because they're not trying to build a long-term relationship with you. It's more a case about just getting the deals done and to hit their KPIs. And unfortunately, that's, yeah, you can absolutely, if you just want someone to facilitate a loan, yeah, you could go to direct to a bank. And if you know exactly that's the best deal for you, absolutely just go for it. But if you want a long-term trusted partner, and someone's actually going to challenge you and be a sounding board for you, then you're not going to get that from a bank. It's just not the service they provide.
And Bossman followed up with a question, are there still training commissions for mortgage brokers? I believe there still are, right?
Absolutely. So there was a little bit of attack on this in the Royal Commission. So good old Matt Cobnan tried to throw brokers under the bus and say go to fee for service, because ultimately they knew that would kill the broking industry. Why do they want to kill the broking industry? Because bank net interest margins have been falling for decades, and a big part of banks' profits come from their home loans, right? And every year broker market share has been going up. When I started, it was circa 40%. What is it, 75% now? And so and there's a true correlation between broker market share and falling net interest margins. And so, yeah, you would argue that, and you could argue, oh, brokers shouldn't get this, etc. But if you go and look at type in MFAA Intelligent Insights reports and go look at the general broking market, isn't making that much money, right? They are absolutely doing a lot of work, and particularly in region areas, and a lot of deals you do that don't go ahead, pre-approvals, refinances, strategies, conversations, etc. that brokers don't get paid on for. And from an ongoing point of view, brokers, instead of getting a larger upfront, they split that to get a smaller upfront and trail commission every year to, so for brokers to provide ongoing service. And there is lots of things that we do. I was actually just looking at our figures for this month, and there's a couple of loans on there for $40,000 that are net of offset. We don't get paid a single cent, but we're doing all the work to help the client release that equity. And so yeah, there's a lot of misunderstanding around, how brokers get paid, and people just think it's how easy it is to lodge loans and get loans approved. But there's a lot more to being a great broker.
Absolutely, and it is interesting how the Trail Commission sort of just dribbles along and creates a bit of ongoing support for the broker industry. Let me go to the next question. Bill asks, how much detail do banks want as part of a loan application? Does it depend on the LVR? And how far should statements go back? So thinking about the evidence that the bank might look for.
Look, I think we need about 6 months for compliance. Ben, who runs our ACL, he's probably more across this than me. But this kind of leads in that compliance part, right? So there's certain things that we need from a bank broker point of view in terms of our compliance with our aggregators and our ACL, and then there's certain things that the bank would need. Bill's made a good point. It does depend on LVR. And the higher the LVR, the more protection they're going to want to see, particularly when you start going in things like lenders' mortgage insurance, etc. They go back more than 6 months, often just 3 months, to be honest. They're not really looking at expenses. They're really just looking to, because they're doing a credit check on you as well. So, yeah, I mean, that was really 2018, 2019. As soon as Westpac won that case, And what's also happened is living expenses, the minimum threshold on HEM has gone up dramatically now. And while absolutely you could say that it'd be hard to live a great life on that amount, it's nowhere near what it was when I started in broking. A couple can live off $1,200 a month or something stupid like that. It was so small, the minimum thresholds, but they've gone up a lot, and they continue to go up with inflation, etc. And so banks aren't too concerned around your living expenses and what you're spending. And but yeah, the higher your LVR is, the more they'll have a look at it.
Thank you, Chris, for that one. And the follow-up question, which is, I guess, in a similar vein, but it's basically on different criteria for houses versus units. So Walt says, do banks have different lending criteria for houses versus units, and which gives more capacity to borrow?
So absolutely. So if you think about from a risk point of view, performance of houses versus apartments, and what goes up and where risks are in the property market. And there's absolutely more risks in the apartment market, particularly when you go into high density in areas where they are building more supply. And so what you'll find is that in those areas, banks will only probably want to lend at, 80% LVRs. They won't do, 90, and LMI won't go there. So yeah, absolutely that. Smaller apartment studios, banks probably won't want to lend on those, or they will, or only some lenders will. So there's definitely some, certain buildings, banks can say, hang on a sec, or postcodes, similar thing. They could just say, I'm not going to lend for apartments in these areas. Houses, they're a lot more forgiving. And so from an asset, point of view, you're fine. Small things like apartments, you've got to include like strata fees, which, does affect your servicing. And so, yeah, they're the main things that will affect you, is the ongoing costs of a unit. They'll have to be factored into your servicing, and does it affect what you can borrow up to in terms of an LVR? They're the main things.
Thank you, Chris, for that one. Let's go on to the next question, which is quite an interesting one too. This is from Maddie saying, looking to refinance a loan to reduce current repayments. What is the longest term, and are banks or non-banks better for getting a longer term loan?
Look, this is when you talk about APRA buffers, 3%, and what are they going to do to lend more money? You've got to think that the banks are going to try to come up with innovative products to lend people more money. And I just think it's not if, but when banks are going to start offering, 40-year loans as standard. There are already some non-banks that will do this. They're starting to become more of them. The benefits of a 40-year loan over a 30-year loan, I'm saying benefits, right? Could be that your repayments are lower, right? Interest rate might be the same, but your obligations from a borrower means that you're paying it off on a longer term. Obviously, the negative of that is that if you do pay it off over 40 years, you're going to pay a lot more interest than if you did over 30 years. So it's obviously in the bank's interest to do that. But from a borrower point of view, you might only live in the property for 7 years anyway, right? And then you might sell it and buy another property. So, I wouldn't be too concerned around a longer loans, because ultimately you pay your loan off on your own terms anyway. If your minimum repayments are $3,000 a month, doesn't mean you have to pay $3,000. You should be paying $4,000, $5,000, $6,000 a month, and be paying off that loan as fast as you can. Whether you do that through the loan or through an offset account, it does depend, but usually an offset account is a good idea. So I think 40-year loans are absolutely going to come. I think they'll probably start doing some innovation with first home buyers and saying, look, this is one way that first home buyers can borrow more money without APRA changing the serviceability buffer. I can imagine first home buyers not having to include HEX debt. There's a bit of talk around that, obviously with Albanese and all that sort of stuff as well. So they're coming. Typically it's been 30 years, but I do think 40-year loans are in the next few years.
Yeah, and in terms of banks or non-banks, I think that there is a similar sort of trajectory on both sides of the fence there. So probably worth talking to both. Let's talk about this one now. This is quite another interesting and fascinating issue. So Joe says, I want to club together with a friend, no relation, to get a mortgage to buy a house. How do we apply? And is there anything to be aware of?
Just be a bit careful here, Joe. Is it a long-term mate? Whereabouts are you both in your life story? And Are you two young chaps just, mates in your mid-20s looking to buy something together? Like,
Yep,
life can change
that's
pretty.
the scenario. Both just under 30.
Yeah, there you go. So, you got to be a bit careful. In this lower borrowing capacity world, though, and combining your deposits together, we've absolutely done this for clients. So I'm not saying, Joe, you shouldn't do it. You've just got to go into it eyes wide open, a very clear strategy on what you're trying to achieve, because all of a sudden, Joe or your friend Matt or Mary might meet somebody, and the 100 grand that they put in and the property you bought together, they might want their money back because they want to buy something for themselves. And so that the investment timeframes and the investment goals have to be really aligned. And so the problem with property is that if you invest over short timeframes in property, because of the cost to transact, stamp duty, selling costs, potentially capital gains tax, holding costs, sunk costs, you may not make much money. And so, particularly under higher interest rates, and if it's an investment that is going to be negative cash flow, then all you can rely on is the growth. And you just got to be careful where you enter, where you buy, and does it get the short-term returns? Because buying something long-term with your friend, the reality is it's probably going to be quite difficult. You're probably going to need that cash plus that borrowing capacity. Hence why you're going in with a mate, is because you haven't got enough for yourself. Or you're doing it because you think you need to do it. But it can work. And so we've seen it where people have done it with brothers and sisters and friends. And CBA, for example, have got a good policy where they split the debt up to your individual names. But one of the dangers of doing it together with a friend is that both your names will be on the loan potentially. And so even if it was, say, $1 million loan, 500 grand each, well, if the other person tries to borrow money in the future, they would say, well, you've got $1 million loan, not 500, because you're both on the loan and you're jointly responsible. And so that's one of the issues we see, where people do it together, and then they, just in terms of the way the banks look at this common debt reducer, you may really stuff up your servicing with your next move. And so your only option is to sell. But if you can buy really well, you can add some value to the property. It means you're going to get a much better asset. Maybe you get some stamp duty concessions, so your entry costs are quite small. And you go in there with a shorter time frame and eyes wide open, then yeah, you might want to consider it, Joe. But definitely document it. Have all those deep conversations up front, and come up with a plan, because you wouldn't want to lose a friendship over not talking something through up front, because money makes people emotional.
I would just say, understand the implications of joint and several liability, right? Because that's the critical point. If for any reason the other party, for some reason, could no longer pay, the bank will come knocking.
Yeah, it's so true, actually. Yeah, absolutely. It's yeah, and that can happen. Lose your job, all sorts of things, right?
Yeah.
It might just and then all of a sudden you have to sell because you can't service it, and bang,
Yeah.
there goes what that potential profit, etc. So yeah, absolutely. Yeah, we've seen that issue.
Yeah, thank you. Right, the penultimate question coming up. This is from Jenny, who said, I just got a survey for a mortgage from CBA. The valuation came in 10% below the purchase price, so the bank cut our offer. Question is it worth shopping around?
Oh, absolutely. I mean, I assume you bought off the plan here, Jenny. It's very rare that this happens when you buy established property.
Yeah, it is off the plan. Yeah.
Yeah. So, and the reason it's quite rare in established property is because you bought it through the market, right? You've negotiated with the seller, and so that sort of is the market price, or you've gone to an auction and you paid what the market needs. In some real boom markets, we sometimes see some issues with it, but it's very, very rare. I've probably done 1,000+ loans, or I have, and it's on a hand how many times. So, when it's an off the plan, absolutely. This is one of the issues. You sign an off the plan contract for an asset that is not built yet, and you're buying it at today's price when you're actually taking the loan out when it's ready to settle. And that might be 1 year, 2 years, 3 years, 5 years down the line. And the markets can move in both directions. It can absolutely go up. I bought the apartment for 800,000, and by the time it was built, it was worth 1.1 million. well, then great. But often what we find is in building booms, when a lot of people buy off the plan, it's usually at a time when a lot of other stock's going to get built. And what seems to have performed quite well in recent times, or looks like a good deal, doesn't look like such a good deal in a few years' time because all these other projects hit the market, and all of a sudden you get a bit of an oversupply, and a lot of people potentially not being able to settle, and then all of a sudden prices start coming down, etc. So in this situation, Jenny, absolutely do a few valuations at a few different banks, and hopefully you can get a valuation as close as you can to purchase price. Look, if you've got heaps of cash and it doesn't really affect you, and you're going to borrow at 60% LVR, and now you're borrowing at, what's that, 60 over 90, 66% LVR, it's probably not a big deal. But if you're absolutely getting close to, not having a buffer and trying to borrow at 80%, or you're going to LMI or something like that, then yeah, try your luck, because you could just find a value that's having a bad day and slapped a pretty conservative price on it.
Yeah, absolutely. And here's the last question coming up, which is this one here. So Gerald says, is the 3% APRA buffer still relevant as we're at the top of the rate cycle now? And on that point, I'll just add in this point that Cookie Boy made the point that the worried about Trump president, his policies sound very inflationary. Bond markets think so. In other words, are we in a situation where rates could actually be higher for longer, or indeed even go higher?
Look, so we'll go with Gerald's question first around the 3% buffer. Look, I think the multiple of income that we're landing on right now is sort of circa 5 times income, and it was 6.5, 7 times income, and so it absolutely is reducing how much people are borrowing. And I guess you've just got to consider that if interest rates do go down, and a lot of people are forced out of the market, is it really fair? And that's what I think the banks are trying to argue, is that wealth inequality is getting worse at times when credit's tougher, I would say. And so is it right thing to sensitize people at a higher rate? Well, yeah, probably, because ultimately it just slows down credit growth, which is going to slow down the growth of our property market. So it's just how you look at it and how you want to, whose interests you want to think about here. If you've got property, you absolutely want it to drop, because it means that credit growth is going to increase and it's going to go straight into prices. And there's going to be a lot of pressure on the banks to do that, particularly when rate cuts happen, because people are going to say it's not really fair. It's really only allowing people on higher incomes to borrow, and you should reduce it. And hence, that was kind of the argument the banks had over the last couple of weeks. But I think it's, they have moved it up and down in previous to tighten when things are getting a bit out of control, and they've relaxed it in certain times in the past. So I reckon it probably is on the table sometime next year when some significant rate cuts look like they're banked in. Look, am I concerned about higher inflation? I do think, rates higher for longer will put a lid on property prices. And so if the concerns around property prices running, well, I think this would slow down growth, absolutely, because buyers won't have that urgency there unless they can really know that the rate cuts are coming, which is what we saw just a couple of months ago. But as soon as that confidence is there, they're going to come out on low listings. I think what higher for longer will also do will stop sellers coming to the market. And so any uncertainty means that sellers don't enter. And so absolutely people are forced to sell with arrears, or they're getting ahead of them or behind on their mortgages, but that's not the majority, right? A third of properties are sort of paid off. A third have got pretty low debt. A third of maybe got medium, and of that third, a portion have got quite high debt compared to their incomes. And so absolutely there'll be, but who's to say that they can't just get to the other side and just batten down the hatches and sell things and lean on family, etc. And so I don't think you'll see a lot of forced selling, even if rates stayed high all the way through next year. I think people will find a way through. But what they will do is they won't transact. And so I think you'll see the quality listings will just stay dry if there's an expectation that rates are going to stay high for longer. And so all you're really doing is consistently going to keep undersupplying the market, and there's going to be still more pent-up demand building. People that want to move out of that apartment into a house, but And so when the confidence around rates comes back, that will happen under low listings. So, yeah, and I think that the longer the rates stay high, probably the harder rate cuts have to be when they finally come down the other end, right? And so, um, does that create extra FOMO when you're seeing 50 basis point cuts versus, 25 basis points and then another 25 basis points 3 months later? You have to wonder about the sentiment on the two different options.
Yeah, and I'll just add my 2 cents there. I think so we are going to see those bond rates are rising higher. If Trump does what he says he does with the tariffs and also the tax cuts, that's going to put a significant extra demand on treasuries in the US. That's going to put them up. We see in Australia the bond rates are actually higher as well. So the expectations of deep cuts soon, I think, are probably off the agenda. But it's what happens in the medium term. And I agree with you, Chris. There are some people who are doing it fine, but there are also a lot of people who are and have been struggling for some time. The longer this goes on, the more the pressure actually is maintained. And, there are a few people now who've gone through a hardship scheme with the bank and are still no better off and are now being forced to actually make those hard decisions. Certainly, I think we're going to see a few forced sales in the months ahead unless things change dramatically. And the events in the last 48 hours, to my mind, probably reinforces the higher for longer story. Which means probably no rate cuts until maybe May next year, if we're lucky. So that's my take on it. But, things could change and we could get a big dip. Conscious that there's an election coming, and I suppose Albo would like to see rate cuts before May.
Yeah, but I think if you look at the Brisbane market, go jump on SQM listings right now if you want to. I mean, everyone can check on different sites, right? But I think their listing data is pretty cool. And go look at the houses in the market versus what was in the market in 2014, 15, massively down. Look at Adelaide, look at Perth. Sydney's, pretty flat to what it was, 5-10 years ago. Melbourne, absolutely. It's a bit more of a basket case down there. And, a lot of investors bailing and absolutely a bit of debt stress. People will say, I want to get out because, but I think you'll find that even if there is forced sellings and there is arrears, but yeah, it's happening into a low listing market, right? The danger would be is if we had a lot of accumulation of listings and, places like Canberra, for example, is happening, right? And that's the market where, the real, instead of the spiral going up and, pushing prices up, if you start seeing more listings come on and they're not selling, then the urgency starts to drop and prices start to drop, etc. And the spiraling effect goes the other way. And go, prices are falling. Oh, well, so I'm going to sit back more. And then more people need to sell. And so that sort of real dire situation, more and more people selling because they can't hold on over the next 12 months. It's only going to be a small portion into a market that I think is undersupplied anyway, right? In a lot of those other cities. And so while there's one person who's having to sell, there's one person who's equally wanting to get into that market because maybe they're in a apartment and they want to upgrade, or maybe they're a first home buyer and they're waiting for that. And so there's, I think it's offset by the pent up demand.
Well, Chris, thank you very much. We've come to the end of the questions and we've done the hour, which I promised it would be no longer than an hour. So I reckon we're going to call it here. I want to say thank you very much for coming on and climbing out of bed to join the stream. That was really quite funny, but interesting comments and very important comments from you there. If people want to find more about Flint Group, where do they go?
Yeah, jump on Flint Group and just put in a sort of fill in the little form there and speak to our team. And absolutely, once we've done your strategy, I'm more than happy to jump on a property call with you and think through what's the right move for you. And I think that's what you really want to be thinking about right now is everyone lives different lives. That's the thing. What makes it interesting for us is every single person has family in different locations, different job prospects, different ways, things that they value and where they want to live and kids and different needs with families, etc., and aspirations long term and where they want to go. And that's what property is. It's about a jigsaw piece, not so much what the market's doing and this, it's what are your properties doing and what's your next best move for your family, because it's not like the share market where you buy an index and that's that easy, right? Property is you're buying big lumpy assets and you're buying 1 or 2 or 3 or whatever it might be, and and you might be buying them over 1 to 10 years, and so it's just thinking through what's the right next piece for you. You're never really going to know, but unfortunately with property, you do have to make a bet on something versus sort of spreading it across, all different stocks in the market. So thanks, Martin. Apologies, I was 8 minutes late. I look forward to having a chat sometime next year.
Yeah, we'll look forward to that, Chris. Thank you very much for coming on, and have a good evening. I'm going to keep the show open a little bit longer, and I've just covered a couple of other issues off, but I'll take you offline now. And thanks very much, Chris, for coming on. Have a good night.
Thanks,
Cheers.
Martin. See you, mate. Bye.
There you go, folks. Well, I hope that was interesting. And, very interesting comments in the chat there, particularly about Melbourne. I have to tell you that my perspective on Melbourne is a bit different from Chris's. I'm seeing significant issues there in the Melbourne market. I'm seeing more listings coming on, particularly from investors. I'm seeing price falls continuing. And I'm also seeing significant problems with people being able to get the mortgages to be able to buy the stuff they want to buy because the valuations are dropping as well. And that isn't just on the outskirts in those high density suburbs. It's actually also happening closer into the town as well, into the city around the CBD. So for me, I think Victoria is a bit of a weather vane as to what's happening. And I'm beginning to see some of the similar trends now spilling out across to Sydney. And whilst we've got Perth still bowling along, it's actually easing back a little. Adelaide is also coming off a little bit as well. So, I begin to wonder what precisely is going on here with regard to property. And I think if rates stay higher for longer, as I think they probably will, we're going to see some of this playing out. Now, next Tuesday, I'm going through my latest modelling because I've updated my story here. And sorry, that's the wrong one. Let's get the right one up. That's that one there. So I'll be looking at the latest household stress and financial modelling and those sorts of things. And we can look at that in a little bit more detail with regard to what's going on. And I've updated my scenarios to take account of the fact that bond rates have been a lot higher, which I think implies that interest rates will be higher for longer. And that actually has a very profound impact on the projections of things like defaults and those sorts of things. So for me, there's quite a lot of interesting conversations to had. And the bottom line is that with people now getting mortgages of 30 plus years and with quite high interest rates, the burden on households in terms of the proportion of their disposable income going on the mortgage is now quite often above 40%, in some cases close to 50%, and renting not far behind. So that puts a profound pressure on those households, but it also has an impact on the broader economy too. The other side of the question is whether, in fact, the default rates that are actually being reported at the moment are actually the true story. And I have a theory to say that some of this is to do with the fact that the banks, through their hardship schemes, are extending and pretending. And we also know that people are being offered longer-term loans and interest-only loans, which allows them to go on for a bit longer. But of course, if things don't turn around with low interest rates, then things are going to be a problem. We know that the pressures on households are continuing because the costs of living continue to rise. And while incomes have risen from some in real terms, for a lot of others, they've not risen back to 2010, 12 to 14. So that's really putting a huge pressure on people. So we'll look at more of that in detail next Tuesday. But nevertheless, I think that was an interesting conversation with Chris tonight. And that those points about making sure you understand what your mortgage broker is doing and providing the right amount of advice, I think is really important. But of course, mortgage brokers tend to be positively aligned to property. So that's just the way things are. Anyway, I want to say thank you very much for spending some time. Jason, thank you very much for your super chat there. And sorry you've been annoyed by what Chris has said. Hopefully what I've said has sort of contextualized it a little more. I actually think that the Melbourne story is looking pretty sick at the moment. And certainly I'm seeing, as Bossman says, Melbourne is stuffed. Yeah, I think it probably is. And unfortunately, some of that is self-inflicted by what the state has done there with regard to some of the changes, as well as some of the broader issues. And Cookie made a couple of interesting points. My tax agent told me a lot of her clients are selling their investment properties, so high rates are biting. Yeah, I agree. I'm seeing that in my net interest, net income calculation for the investment properties. In some places more than half. And also, Cookie says, why are Westpac cutting their arrears? NAB is starting to look bad. Yeah, NAB reported a significant hike in arrears in their mortgage books today. And I think that's very significant. Bossman says, I'm not the issue. Thank you very Thank you for that. Well, you get a range of people on the show. Sometimes you won't necessarily agree with everything, but hopefully there's still some wisdom there tucked away. And Fraser also says Victoria is a basket. Jason says, cheers. It's all in the chat. Ignore Chris's advice on investing in Victoria, in my opinion. Night all. Stay well, everyone. Yep. I think that's probably not a bad way to finish the show. Anyway, before I do that, here are the dogs, still asleep. The doorbell rang, but luckily they didn't get up and bark too much. So that was all right. And I'll look forward to seeing you on the next live show, which will be back to our regular Tuesday evening, 8 p.m. Sydney time next Tuesday. And that'll be a deep dive on my latest analysis and modeling. And we'll also be thinking about some of the sensitivities with regard to bonds. In fact, Cookie has thrown in this question about the bond rates. When do we start worrying about bonds? Well, I think we should be worrying now. The bond rates have two profound impacts. Firstly, of course, they actually drive mortgage rates. And if bond rates are up, mortgage rates are up. But also more broadly, of course, the debt that is there for governments, which continues to rise, charges a lot more. That means that they have less money to spend on other things. And that's the problem in the UK. It's the problem in the US and the problem in Australia at the moment. The bond rates are actually having a huge, huge impact. So I think that's a really important point. I don't see bond rates coming back down to anything like they were previously unless we get a global crisis of some sort, which means that the impost on government finances into the future is going to be significantly higher than it's been in the past. And just remember that from 2007, governments got away with murder because they were able to take rates lower and lower and lower and lower and lower as the central banks did that. They can't do that now because of the inflationary pressures, and also the bond markets are in a different mode. So watch this space. The Fed, of course, comes out with their decision. I expect a small cut this time, but then probably will do nothing until Trump gets in, and we'll see how that plays out. I think Australia won't see a rate cut for some months now. Anyway, thank you very much for spending time with us this evening. I hope you found that an interesting, informative show, and I'll look forward to seeing you on next Tuesday's show at the normal time, 8 p.m. Sydney. This is Martin North from Digital Finance Analytics, signing off. We'll see you next time. Take care.